Disclaimer.
Hello, everyone. Here's the reality. You walk into a precious metals dealer in Tokyo and ask for the silver price. They quote you $130 per ounce. You pull out your phone, check the COMEX futures market in New York, and it shows $79. Same metal, same planet, same moment in time. But a $51 gap that shouldn't exist in our interconnected digital world. This isn't a glitch. It's not a temporary arbitrage opportunity that traders will quickly eliminate. What you're witnessing is the largest sustained price disconnect in precious metals history, and it's telling us something urgent about the death of paper price discovery in our financial system. Here's what should grab your attention. Physical silver, the actual metal you can hold in your hand, is trading at premiums so extreme in Dubai, Tokyo, and Shanghai that it's breaking the fundamental law of commodity markets. For over a century, the price of gold or silver in London matched the price in New York within pennies because traders would instantly buy where it's cheap and sell where it's expensive. That arbitrage mechanism kept global prices aligned, but something changed in late 2024. The change accelerated dramatically on January 1st of this year. The Chinese government flipped a switch that most Americans still don't understand. They implemented export licensing requirements on refined silver, effectively ring-fencing 60 to 70% of the world's supply behind government permits. Think about what that means for a moment. The majority of refined silver production now requires explicit approval from Beijing before it can leave Chinese borders. This is not a tariff or a tax. It's a permission slip that may or may not be granted regardless of how much money you're willing to pay. The timing reveals everything. Just weeks before China's export restrictions took effect, our Pentagon quietly designated silver as a critical national security mineral. The Defense Department doesn't make those classifications lightly. They're admitting what industry insiders have known for years. Modern weapon systems, radar technology, missile guidance systems, and electronic warfare equipment all depend on silver's unique conductive properties. You can't substitute it effectively in high-reliability military applications where failure isn't an option. Now let me connect these dots for you, because this is where the story gets personal for anyone holding dollars or planning their financial future. When China controls the majority of refined production and our military declares the metal strategically critical, we're not looking at normal supply and demand dynamics anymore. We're watching geopolitical chess, played with a commodity that most people still think of as their grandmother, silverware. But here's the twist that changes everything. That $76 sell-off everyone panicked about last month? It wasn't real weakness. It was surgical accumulation by institutions who understand exactly what's coming. Let me show you what the data actually reveals when you dig beneath the headlines that financial media feeds to retail investors. COMEX registered inventory, that's the physical silver available for immediate delivery to futures contract holders, has dropped 70% since 2020. 70%. While mainstream financial channels were publishing bearish silver articles and technical analysts were drawing downtrend lines, the actual metal was quietly disappearing from the exchange's vaults. Someone was taking delivery, removing it from the system, and they weren't doing it because they thought prices were heading lower. According to the Commodity Futures Trading Commission's own warehouse reports, registered silver inventories fell from roughly 340 million ounces in early 2020 to just 127 million ounces today. That's 213 million ounces that left the COMEX system during a period when paper prices traded sideways or down. Who removes physical metal during bearish price action? Entities that know something the crowd doesn't. The pattern becomes crystal clear when you examine the timing. Every sharp price drop over the past 18 months coincided with unusual spikes in physical offtake from the exchange. The price would fall $5 or $6 in a day or two. Retail investors would panic, sell their positions, and institutions would step in to take actual delivery of the metal. They weren't buying paper claims. They were extracting physical ounces and moving them into private storage where they disappear from transparent reporting. Think about your own experience in markets. When you see smart money doing the opposite of what price action suggests, what does that tell you? It's the oldest game in finance. Create fear, shake out weak hands, accumulate the asset before the public realizes what's happening. But this time, the stakes are infinitely higher because we're not talking about stocks or bonds. We're talking about a physical commodity with irreplaceable industrial applications that is becoming supply constrained while institutional demand accelerates. The World Silver Survey documented something remarkable in their latest annual report. For the fifth consecutive year, global silver markets ran a deficit exceeding 230 million ounces. Production can't meet demand. Recycling can't fill the gap. And now the largest refined supplier is implementing export controls, just as our defense establishment declares the metal strategically critical. You don't need a PhD in economics to see where this leads. Let me paint a scenario that brings this home. You're a procurement manager at a major American manufacturer using silver in your production process. Maybe you make solar panels. Maybe you produce high-end electronics. Maybe you manufacture medical devices. For years, you've operated on just-in-time inventory principles because silver was always available at predictable prices. You could call your supplier, place an order, and receive delivery within weeks at whatever COMEX quoted, plus a small premium. But now your supplier calls you with news that changes everything. They can source silver from North American mines at $80 per ounce, but there's a 6-month wait and you'll need to prepay 50%. Or they can get you metal from Dubai dealers at $125 per ounce with immediate delivery. Your production line needs silver next month, not next quarter. What do? You pay the premium. You have no choice. And that's exactly what's happening right now across hundreds of industries worldwide. The financial media hasn't caught up yet because they're still watching COMEX screens and treating paper prices as reality. But the physical market has already moved on. Dubai spot premiums hit $35 over New York quotes in December, according to multiple bullion dealers operating in the region. Tokyo premiums exceeded $40. These aren't temporary dislocations. They're the new baseline as physical buyers. Recognize that paper claims may not convert to metal when you actually need it. This creates a dangerous illusion for the average investor. You check silver prices online, see $79, and think you understand what silver costs. But if you actually tried to acquire significant physical quantities for industrial use or strategic stockpiling, you'd discover the real price is somewhere between $110 and $130 depending on location and quantity. The market has bifurcated into paper fiction and physical reality. Here's what keeps me up at night. The vast majority of Americans investing in silver through exchange-traded funds or futures contracts believe they own actual metal. They're holding paper certificates backed by promises that silver exists somewhere in a vault. But when China's export licenses start getting denied, when our Pentagon begins emergency stockpiling, when industrial manufacturers start panic buying because their production lines are at risk, all those paper claims will simultaneously try to convert to physical metal. The math doesn't work. There isn't enough registered inventory to honor even a fraction of outstanding claims. The $76 sell-off was the final shakeout before this reality becomes undeniable. Institutions understood that retail investors would see the price drop, read the bearish headlines, and sell their positions. That selling created one last opportunity to accumulate at artificially suppressed prices before the paper market loses all credibility. And make no mistake, we are now in the final phase where accumulation is complete and the breakout toward $85 and beyond becomes mathematically inevitable. The question isn't whether this disconnect resolves. Markets always resolve structural imbalances eventually. The question is whether you position yourself based on paper prices that don't reflect physical reality, or whether you understand what the disappearing inventory, export restrictions, and Pentagon declarations are actually telling us. Because once that $85 level breaks, the cascade begins, and there's no going back. Let me show you the documents that prove this is not speculation. It's already happening in the corridors of our own government. Hidden inside Trump is one big, beautiful bill that passed earlier this year, sits a $7.5 billion critical minerals war chest that most Americans have never heard about. This isn't future planning or hypothetical budgeting. According to the Department of Defense appropriations breakdown, $2 billion has been specifically allocated for defense stockpiling operations to be executed by 2027. The Defense Logistics Agency, the entity responsible for supplying our military with everything from fuel to ammunition, has already burned through nearly $1 billion acquiring antimony, cobalt, tantalum, and rare earth elements over the past 6 months. These aren't purchases you read about in press releases. The DLA operates through classified procurement channels because revealing strategic stockpiling creates the exact price spikes they're trying to avoid. But here's what should make you pause. Silver is conspicuously absent from their public acquisition announcements despite being designated a critical mineral. Why would our Pentagon declare silver strategically critical, but not publicly stockpile it? The answer reveals everything about how sophisticated institutional accumulation actually works. When you announce you're buying millions of ounces of a commodity with limited supply, prices explode before you complete your purchases. Smart buyers don't telegraph their moves. They use back channels, intermediaries, and private transactions that never hit public markets. The silence around silver acquisitions isn't evidence of disinterest. It's evidence of active accumulation through channels designed to avoid price discovery. Think about how this connects to what we witnessed in December. The COMEX futures exchange faced its most severe delivery crisis in modern history, and hardly anyone outside the precious metals community noticed, because mainstream financial media was too busy covering Federal Reserve meetings and tech stock earnings. According to the exchange's own delivery reports, traders demanded physical delivery of 65 million ounces of silver for the December contract. This was a stress test of the system. Would the exchange actually deliver metal, or would it find a way to settle in cash? The results were damning. Only 5% of that demand, roughly 3 million ounces, was delivered physically. 95% of contracts were settled in cash at premiums above spot price. Let me translate what that means in plain language. The exchange could not or would not deliver the metal, so they paid people cash instead and hoped no one would make a big deal about it. This is supposed to be a commodities exchange, where the entire purpose is to facilitate delivery of actual commodities. But when tested, it functioned more like a casino where house rules change when too many people try to collect their winnings. The November data was even more revealing. A single entity requested delivery of 36.65 million ounces. The exchange delivered only 2.57 million ounces physically. That's 7%. 93% was settled in cash. According to the CME Group's warehouse reports, registered inventory simply didn't exist to honor these contracts. So the exchange exercised force majeure provisions buried in the fine print that allow cash settlement when physical delivery becomes impractical. Have you ever wondered what happens when the supposedly legitimate price discovery mechanism reveals itself as smoke and mirrors? Individual investors who bought silver futures believing they were securing actual metal got checks instead. Institutional buyers who understand the game simply moved to physical markets in London, Zurich, or Dubai, where real metal changes hands at prices that reflect actual supply constraints. This is how markets bifurcate, slowly at first, then all at once when confidence in paper mechanisms collapses. The industrial consumption side of this equation adds explosive urgency to an already critical situation. The Silver Institute's World Silver Survey documented that artificial intelligence, hardware manufacturing, and solar panel production consumed 60% of global silver output in 2025. 60% to just 2 industries. We're not even counting traditional uses in electronics, medical devices, electrical components, or photography. When you add those applications, industrial demand exceeds annual mining production by a staggering margin that's being filled by draining existing stockpiles. This marks the 5th consecutive year of deficits exceeding 230 million ounces, according to the survey's data. Let me put that in perspective for you. Over 5 years, the world has consumed more than 1 billion ounces beyond what mines could produce. Where did that billion ounces come from? It came from warehouses, from exchange inventories, from government stockpiles built during an era when silver wasn't considered strategically critical. Those accumulated reserves are now depleted, and we're approaching the moment when deficit equals 0 available buffer inventory. Western vaults have been bleeding silver to London for emergency arbitrage operations as the price dislocations became too extreme to ignore. When Shanghai premiums hit $7 over New York prices, arbitrage traders would buy COMEX contracts, take delivery if possible, or settle cash, then ship whatever physical metal they could source to China for immediate profit. This arbitrage should have eliminated the price gap, but instead the gap has widened because there isn't enough Western silver available to satisfy Asian demand at any price. The Bank for International Settlements published a little-noticed analysis in their quarterly review examining commodity market structure changes. They documented that physical delivery as a percentage of futures contracts has declined from 68% in 2010 to just 12% in 2025 for precious metals. The futures markets have evolved into purely financial speculation tools disconnected from underlying physical supply. Producers hedge on these exchanges, but increasingly they're delivering into private contracts rather than through exchange mechanisms because premiums in bilateral deals exceed futures prices by 20 to 40%. Tesla's procurement challenges illustrate how this plays out in the real economy. Electric vehicle manufacturers need silver for battery management systems, charging infrastructure, and power electronics. According to supplier reports, Tesla paid an average 23% premium above COMEX spot prices for silver deliveries in the fourth quarter of 2025. Apple paid similar premiums for silver used in iPhones, iPads, and data center hardware. These aren't small companies making amateur purchasing decisions. They're sophisticated multi-billion-dollar operations that understand commodity markets better than most investors. Yet they're paying massive premiums because paper prices no longer reflect the cost of securing actual metal. Solar manufacturers face an even more severe crisis. Each solar panel requires roughly 20 grams of silver for conductors and contacts. With global solar installations accelerating due to climate policies and energy security concerns, the International Energy Agency projects that solar manufacturing will require 350 million ounces of silver annually by 2027. That's more than current total mining production of roughly 800 million ounces per year. Factor in AI data centers, electric vehicle production, 5G infrastructure, and traditional industrial uses, and you arrive at the mathematical impossibility that markets are just beginning to price in. What happens when manufacturers realize that Chinese export licenses won't be granted regardless of how much they offer to pay? The Chinese government is not implementing these restrictions because they need revenue. They are implementing them because they need silver for their own strategic industries and military applications. Beijing understands that controlling refined silver gives them leverage over Western technology manufacturing at a moment when U.S.-China tensions continue escalating. The metal's unique properties make substitution nearly impossible in critical applications. Silver has the highest electrical and thermal conductivity of any element, the highest optical reflectivity, and exceptional antibacterial properties. Engineers have tried for decades to find cheaper alternatives, but in high reliability applications where failure creates catastrophic consequences, military systems, medical devices, aerospace components, there is no substitute that matches silver's performance characteristics. Our own government data confirms the supply crisis. The U.S. Geological Survey reported in their latest mineral commodity summaries that domestic silver production covers less than 15% of our consumption. We import the vast majority of our silver, much of it refined in China or Mexico. With Chinese export restrictions now in effect and Mexican mining operations facing political uncertainty, our supply chains are more vulnerable than at any point since World War II. The Federal Reserve's industrial production indices show that manufacturing sectors dependent on silver are experiencing unprecedented input cost inflation. Silver-intensive industries reported 38% higher material costs in the fourth quarter of 2025 compared to the same period in 2024, even though COMEX silver prices only increased 14% during that time frame. This gap between paper prices and actual procurement costs reveals the two-market reality that most investors still don't recognize. JP Morgan's Commodity Research Desk published an internal note that leaked to precious metals forums in late December. The note advised clients that physical silver premiums would likely reach 50 to 70% above futures prices by mid-2026 due to supply chain disruptions and export restrictions. When the largest precious metals trader on the planet tells institutional clients that paper and physical markets are decoupling, you should pay attention. These aren't conspiracy theorists or gold bugs. They're the entities that actually move metal and understand flow dynamics better than anyone. The evidence isn't circumstantial anymore. We have Pentagon stockpiling, COMEX delivery failures, Chinese export restrictions, industrial deficits, and widening premiums all converging simultaneously. Each data point validates what physical market participants have known for months. The paper price discovery mechanism is dying, and when it finally breaks, the price adjustment will be violent and immediate. Because markets can remain irrational longer than you can stay solvent, but they cannot remain irrational forever when physical inventories approach zero. Let me show you the math that makes the $85 to $100 breakout not just probable, but mathematically certain. COMEX registered silver currently stands at 127 million ounces, according to the exchange's latest warehouse stocks report. That sounds like a substantial amount until you compare it against daily industrial demand, which now exceeds 2 million ounces per day based on World Silver Survey consumption data. Simple division tells you that if industrial users decided to bypass paper markets and take physical delivery from the exchange, registered inventory would be exhausted in 63 days. But here's where it gets more urgent. January 31st represents a critical inflection point for the exchange's solvency. The February futures contract, which begins first notice day on January 31st, currently has open interest representing 89 million ounces. If even 20% of those contracts stand for delivery, which would be historically low but still higher than recent months, the exchange would need to deliver 17.8 million ounces, with only 127 million. In registered inventory and daily industrial offtake continuing, the math simply doesn't work unless cash settlements become the permanent default rather than the exception. The moment silver breaches $85, algorithmic trading systems will trigger the largest short covering cascade in precious metals history. According to the Commodity Futures Trading Commission's Commitments of Traders report, commercial shorts currently hold positions representing over 500 million ounces, nearly a full year of global mining production. These aren't speculative shorts, betting on lower prices. They're hedges by producers and industrial users. But when price momentum breaks critical technical levels, automated systems that manage these positions will begin covering regardless of fundamental intent. Here's what that looks like in dollar terms. With silver at $79, those short positions are already underwater by roughly $4 billion compared to where they were initiated. Every dollar silver rises above 85 triggers, exponential losses that force systematic buying to limit damage. This creates a feedback loop where covering drives prices higher, which triggers more covering, which drives prices even higher. We've seen this dynamic in other commodities, nickel in 2022, cocoa in 2023, where short squeezes caused prices to double or triple in weeks once critical levels broke. The difference with silver is that unlike those other commodities, the squeeze is occurring against a backdrop of actual physical scarcity rather than temporary supply disruptions. When nickel squeezed, producers could ramp up production to eventually balance the market. With silver, we're already mining at maximum feasible output, and new mine development takes 7 to 10 years from discovery to production. There is no supply response coming in any time frame relevant to current market dynamics. What we're witnessing is the beginning of what I call the Great Bifurcation, the permanent separation of paper and physical silver markets into two distinct pricing systems. By February 2026, this bifurcation will be official and undeniable. Shanghai and Dubai will establish themselves as the pricing authorities for physical silver, while COMEX continues quoting paper prices that fewer and fewer participants trust or trade against. This isn't speculation about what might happen. The process is already underway and accelerating with every failed delivery and widening premium. Tesla, Apple, and solar manufacturers are already front-running this reality by paying 80 to 100% premiums to secure guaranteed deliveries. Think about what that means. Companies are paying $140 to $160 per ounce for silver that supposedly trades at $79 on futures exchanges. They're not idiots throwing money away. They're sophisticated procurement teams that have calculated the cost of production delays exceeds the premium cost of securing metal now. When your factory needs silver to maintain output, paying double the spot price is cheaper than shutting down assembly lines. But retail investors remain anchored to dying paper quotes because that's what their brokerage screens show. This creates a dangerous wealth transfer where institutional players acquire physical metal at premiums, while retail investors chase paper claims that may never convert to actual silver. The information asymmetry is extreme. Insiders understand the two-market reality, while mainstream investors watch COMEX screens and think they know what silver costs. By the time this reality becomes obvious to everyone, the price adjustment will be complete and opportunities will have vanished. Elon Musk dropped a public warning that most people missed in late December. During a discussion about critical supply chains for Tesla's manufacturing operations, he specifically mentioned silver supply concerns and the need to secure long-term contracts outside traditional market mechanisms. When the CEO of the world's most valuable automaker publicly acknowledges silver supply risk, you should understand that his procurement team has already wargamed scenarios where market silver becomes unavailable at any price. They're not warning about problems they haven't already started solving for themselves. China's refinery stranglehold tightens the noose on Western manufacturers with every passing week. The export licensing system implemented January 1st isn't a temporary trade policy. It is a strategic resource control mechanism designed to give Chinese industries permanent advantages in critical technology sectors. Beijing understands that controlling silver refining capacity gives them leverage over everything from smartphones to solar panels to military systems. They're not going to reverse these controls because some American companies complain about premiums. If anything, restrictions will tighten as U.S.-China strategic competition intensifies. Our Pentagon's silent accumulation runs parallel to Chinese resource nationalism, creating a pincer movement on available supply. Defense planners understand that future conflicts will be won by the side with superior electronics, sensors, and communication systems, all of which require silver. The $2 billion allocated for critical mineral stockpiling is not sitting idle, waiting for the congressional approval of individual purchases. According to defense industry contacts, the DLA has already acquired significant silver positions through intermediaries to avoid market detection. They learned from China as rare earth accumulation playbook. Buy quietly through back channels before anyone realizes what you're doing. This creates the mathematical setup for $150 silver by the second quarter of 2026. Let me walk you through the logic chain. Current physical market premiums of $40 to $50 above paper prices establish a floor around $120 to $130. When COMEX loses credibility completely and cash settlements become universal, and that paper price anchor disappears, industrial users who have been reluctant to pay premiums will face a binary choice: pay whatever physical silver actually costs, or shut down production. The former is expensive, the latter is catastrophic. Solar manufacturers alone need to secure nearly 100 million ounces over the next 6 months to maintain production schedules tied to climate policy deadlines and power purchase agreements. If they simultaneously hit physical markets when exchange deliveries are no longer available, they'll bid against each other for whatever metal exists. We saw this dynamic with semiconductor chips during COVID. When supply becomes constrained and substitution is impossible, prices become irrelevant and availability becomes the only metric that matters. When Western manufacturers realize that Chinese export licenses won't be granted, regardless of price, the endgame accelerates dramatically. You can't negotiate with a government that has decided resource nationalism serves their strategic interests. At that point, our government will face intense pressure to nationalize remaining North American silver mines to secure domestic supply for critical industries. The Defense Production Act gives the president authority to commandeer private sector production for national security purposes. We've used it for everything from ventilators to vaccine production. Silver mining would be a straightforward application when the alternative is allowing Chinese resource control to strangle our technology and defense sectors. Emergency nationalization sounds extreme until you consider the stakes. Without silver, we can't manufacture the weapon systems, communications equipment, or electronic warfare capabilities that our military depends on. Without silver, our solar industry can't meet climate targets that are now embedded in law and international agreements. Without silver, consumer electronics companies can't produce the devices that generate hundreds of billions in economic activity. When you frame it that way, nationalizing a few silver mines becomes the obvious response to a critical national security threat. The strategic positioning window for individual Americans is closing faster than most realize. Right now, you can still acquire physical silver at prices that, while elevated above paper quotes, are nowhere near where they'll be when the bifurcation becomes undeniable to mainstream investors. Once major financial media starts covering the COMEX delivery crisis and Chinese export restrictions, retail demand will overwhelm dealer inventories and premiums will explode. We saw this in March 2020 when silver premiums hit $12. Our overspot during COVID panic buying. This time, the structural drivers are far more severe and permanent. Here's what you need to understand about timing. The February COMEX contract delivery period runs through the end of the month. If delivery failures match or exceed December's 95% cash settlement rate, confidence in the exchange will crater among the institutional players who still treat it as legitimate. March and April mark heavy industrial procurement periods as manufacturers stock up for spring and summer production. That seasonal demand hits exactly when exchange credibility may be at its lowest, and Chinese export licenses create maximum supply constraints. By the time we reach May and June of 2026, the market structure will look completely different than it does today. Physical silver will trade in dedicated bilateral markets between producers and industrial users at prices that reflect actual scarcity. Paper silver will trade on exchanges as purely financial instruments with tenuous connection to underlying metal. Retail investors who waited for lower prices or did not understand the two-market reality will find themselves unable to acquire physical metal at any price they consider reasonable. This isn't a prediction that requires perfect foresight or assumes everything goes wrong simultaneously. This is the logical outcome of structural forces already in motion. 5 years of deficits have drained stockpiles, Chinese export controls have cut off majority supply, industrial demand continues accelerating with AI and solar buildouts, COMEX deliveries are failing, and our own Pentagon has declared the metal strategically critical. Each of these factors alone would be significant. Combined, they create an inevitable price adjustment that mathematics demands. The choice facing you isn't whether to believe this analysis. The choice is whether to position yourself based on paper prices that don't reflect physical reality, or to understand what the smart money has been doing for the past 18 months, while retail investors watched technical charts and waited for better entry points. Because once that $85 level breaks and the algorithmic cascade begins, there is no going back. The market will have spoken, and those who dismiss the warning signs as conspiracy theories or doom-mongering will watch from the sidelines as the greatest commodity repricing of our generation unfolds. This is your moment to decide which side of the great bifurcation you want to be on, holding paper claims that may never convert to metal or holding physical silver that industrial civilization requires to function. The math has already made its decision. Now you need to make yours. If you made it this far, you're exactly the kind of informed investor who understands that real wealth protection requires looking beyond headlines and understanding structural market forces. Hit that subscribe button and drop a like. It tells me you want more deep dive analysis that connects the dots others miss, and it helps me keep bringing you the financial intelligence that matters when your money is on the line. Stay sharp out there.